Will subprime auto loans trigger the next financial crisis? And could it happen in 2023? I'm going to answer those questions for you in 3 simple, fast steps. Step number 1, let's go over car prices now compared to home prices in 2008 or prior to the last global financial crisis. We start with a chart going all the way back to 1998, all the way to today's date. And on the left, we go from 120 up to 220. This is an index of used car and truck prices. Starting in, call it 1997 or so, we're about 160. And again, what this chart does is it gives you the overall prices adjusted for inflation. So 1997, about 160, goes down a lot after the dot-com bust, and then kind of trends down, which I thought was very interesting, that used car prices and truck prices are actually, if you look at the trend, flat to down since, call it 1997, if we stop, and this is key, at 2020. More on that in just a moment. But going back to this, GFC, it really crashes and goes back up, and then we see it gradually just kind of work its way down till we get to this point, which really sticks out on the chart in 2020, where it goes completely parabolic, and prices go up by over 50%. But what's really important to notice, and I think this is the key, is that this price increase happens within the span of 2 years. Now you say, George, okay, well, why is that a big deal? Editor, go ahead and throw up a chart of housing prices adjusted for inflation. And we can see in the 1990s, prices were trending down as well, similar to this chart of used car and truck prices. But then in 1998, 1999, we all know what happened. Prices went parabolic and peaked out in 2006. A little over 60% from where they started. This insane price increase happened over the span of, call it, 6 years, where this insane price increase happened over the span of about 2 years. So, one thing I want to point out here is that these prices usually revert to a mean. Why is that? Well, it makes sense. Because people pay for a house or people pay for a car, even if it's a monthly payment, out of their income. So you would assume that if you kept interest rates constant, more on that in just a moment, because we know interest rates are not constant and they've been increasing dramatically as of late. But if you kept interest rates constant, then home prices and car prices, you would assume would be a function of real income. Also, supply and demand. But supply and demand, the dynamics I think are slightly different with cars, because I would argue it's a lot easier to fill demand with cars or additional supply of cars than it is through housing stock. Whoa, time out. One thing I want to make crystal clear is that if you look at real incomes, and this is incomes adjusted for inflation, over the past year, we see that they've actually gone down. You hear in the mainstream media all the time that wages are increasing, and that is true, but they're increasing in nominal terms. Again, when you adjust for inflation, you see that real wages are going down, not up. And this would increase the probabilities that we continue to see price declines with used cars and trucks. So the bottom line is, just like home prices came all the way down from 2006 to 2012 and bottomed out at their historic trend line, I think used cars and trucks will do the exact same thing. So I would be prepared for prices to not only come down from where they were just, let's say, 6 months ago, but I would also assume that they would continue to go down all the way to where they were at the end of 2019. So the next question becomes, if prices continue to collapse, what will this do to the subprime auto loan market? And what will this do to the banking system? Could this be a repeat of what we saw with the subprime mortgages in 2008 and GFC number 1? Step number 2, we saw how the housing bubble was very similar to the car bubble that we're living in today. So now let's go ahead and compare interest rates to further determine whether or not this is something that we should be concerned with moving into 2023. We start with a chart going all the way back to 1970 to today's date. This is a chart of interest rates on new auto loans that are 48-month. I don't know if those even exist anymore. The last time I heard, people are doing crazy stuff like 72 months or a 30-year auto mortgage, who knows? But that's what this chart represents. And on the left, of course, the interest rate from 0% up to 20%. In 1975 or so, interest rates on new auto loans, 48-month again, about 10%. They go up, as you would imagine, when Volcker raises rates to a peak of around 20%. Since then, they've come all the way down, as you would imagine, to about 5% just before and during the cerveza sickness. But recently, you guys know what they've done. They have gone straight up because of Jerome Powell increasing interest rates, among other things. So I want to point out that we went from 5% interest rates on auto loans up to roughly 10%. So the interest rates have almost doubled, let's say, over the last year in this market. So editor, go ahead and throw up a chart of mortgage rates prior to the GFC. And we can see that these interest rate increases were substantially less than what we see in the car market today. Definitely an ominous warning sign. Oh, but wait, there is more. Let's look at the subprime category of home loans back then compared to car loans today. Prior to the GFC, the subprime percentage of overall home loans was about 23%. Today, with the auto industry, about 34%. When you look at how quickly interest rates have gone up and how much they have gone up, and then you also consider the fact that there's a much greater percentage of subprime borrowers in this market, you see very quickly that many of the metrics are far worse today with the car market than they were prior to the GFC in the housing market. Step number 3, to answer the question, will subprime auto loans trigger the next financial crisis? Or maybe will the car market collapse, trigger the next financial crisis? We have to look at the risks to the banks. But before we do, I want to cut to a clip from my good buddy Adam Taggart's podcast, Wealthion, where he discusses some of the nuances to the problems the car industry is facing right now in 2023.
Between 2020 and 2021, it seemed like lending standards for auto loans just dropped, down into the core of the earth. I mean, it was just like they would give a loan to anybody with a pulse who had a stimulus check to spend, right? Just like we did with housing, So my concern is that what we're going to see this time around, like this market cycle's subprime is going to be the auto market, the way that the housing was back in 2008.
Oh, 100%. I mean, you hit a nail on the head. When we were starting to go into not recession, but the pandemic, we were buying cars back a book, operating the same principles. And then all of a sudden we started hearing multiple banks saying, hey, you know what, we're going to give you instead of, let's say, on a prime customer, we're going to give you 110% of LTV. So if the customer has good credit, they don't want to put no money down, we can cover sales tax and maybe a few bucks of aftermarket products, warranties, etc. They were going up to 150, 160%. So I was like, okay, maybe they're going a little extra because people just don't want to spend the money and they're stimulating sales. That's originally how we thought it was. They were just going out of the way to stimulate sales. But then all of a sudden they brought the subprime markets into it. People that we usually would lend 90% of LTV, giving them 130, 140, 150% loan to value, and it blew my mind. So all of a sudden, this rush of all these, we call them stimulus ballers on my channel, people that, that didn't pay their rent, that waited 3 months, got a big stimulus check from the government, had $10,000, $12,000 to spend, just showed up to the dealerships. When it came to stimulus money, they didn't ask for like past bank statements. They didn't do a lot of the same things. They just saw all this free money coming from the government, and they're like, we're going to pump these loans out, get them, and then we're just going to hold on them for a little bit and then sell them to another bank to see who wants to take, the loss. And so the frenzy began. Everybody was just buying deals left and right. The prime banks got into it first, subprimes got into it now, and then all of a sudden they collected all these auto loans, all these auto portfolios, bundled them off, and they started selling them off to each other, basically almost like a deadly game of hot potato.
So as you can see, this is a serious, serious problem. But will it lead to the next financial crisis? My answer is no. And here is why. Let's look at two banks' balance sheets. And these banks represent the entire banking system in the United States. So the banking system in aggregate total. We've got pre-bank, that would be pre-GFC, and post-bank, post-GFC. So prior to the GFC, if we look at the asset side and the liability side of the banking system's balance sheet, we see that on the liability side, they had about $7.5 trillion in M2 money supply. So that M2 money supply would be a liability of the commercial banking system. Okay, now they had more liabilities than that, but we're just oversimplifying their balance sheets for the sake of this video and understanding the overall concept. So what did they have to back up that 7.5 trillion? Well, as far as bank reserves, they had a whopping total of 40 billion. That's not 400 billion. That's 40 billion. So if you do the back of the napkin math, you see that that was 0.5%. So I don't want to go off on a tangent, but if anyone asks you about reserve requirements and if they impacted the amount of dollars circulating in the real economy, you could just point them to this statistic that shows very clearly that reserve requirements had no impact pretty much whatsoever on the amount of M2 money supply or broad money. But coming back to the topic of this video. So I drew this little pie chart here, and it's not exact, but again, just gives you the idea of the overall concept. So this would be the assets on the bank's balance sheet in aggregate total, backing up that 7.5 trillion in commercial bank deposits or liabilities. So let's just assume for a moment that they had this little sliver here of bank reserves. That was the 0.5%. And they had a much bigger portion of this pie chart with mortgage-backed securities. And then they had treasuries. Okay, well, we know that a large portion of these mortgage-backed securities got a huge haircut very rapidly, meaning that the value of these mortgage-backed securities on their balance sheet went from, let's say, this down to this very quickly. I can't make it any easier than that. And this is one of the things that contributed to the GFC. But now let's go ahead and fast forward to post-bank. On the liability side of their balance sheet, they've got 21 trillion in M2 money supply. On the asset side, though, they've got 3.1 trillion in reserves as a result of the Fed doing quantitative easing. So this now is 14% bank reserves to back up that 21 trillion in M2 money supply or commercial bank liabilities. Now let's go ahead and look at this new and revised pie chart. And actually, something's missing here. I forgot to put the treasuries. So we'll go ahead and assume for a moment that this bigger portion is all treasuries. It's not, but let's assume that it's something that's relatively safe. Okay, so we've got the 14% bank reserves, but now we have a much smaller slice. We do have some of these mortgage-backed securities, and you could argue as to whether or not those are quote-unquote safe. But focusing on the main topic of this video, they would have a much smaller slice allocated to subprime car loans than they had subprime mortgages back prior to the GFC. So the first reason I would give you as to why I don't think the collapse in the car industry will lead to the next financial crisis is the collateral on the bank's balance sheet today is much different than it was pre-GFC. And I would argue, although the bank's balance sheets are far from pristine, they have a lot less toxic sludge, if you will, in the form of these subprime loans on their balance sheet today than they had in 2007. Another reason I think the banks are less risky today is because they are literally getting free money. My good friend and business partner, Lynn Alden, talks about this all the time. So I showed you before how their reserves have gone from 40 billion up to 3.1 trillion. But that's not the only thing that changed. Before the GFC, the Federal Reserve did not pay the banks interest on their reserves. After the GFC, as most of you know, they do. And as the Fed increases interest rates higher and higher and higher, now with the Fed funds rate over 4.3%, so let's call it 4.35%. That is the interest rate the Fed is now paying the banks on 3.1 trillion of reserves that they have on the Fed's balance sheet. Now, what would have happened in the past is the banks would have competed for your deposits, for your money, because you would lend them your dollars, and that would be a cheaper way of getting the bank reserves they needed to conduct business. But now they're so flushed with reserves, they don't want your money. They don't even need it. And this is why you see such a massive discrepancy in what the banks are willing to pay you on a savings account, let's say, compared to what they are getting on their savings or their checking account held at the Federal Reserve. The last time I looked, the average interest rate on a savings account was about 25 basis points. And again, compare that to the, let's say, 4.25% or 425 basis points the banks are getting paid. They're literally getting a spread of 4%. This is going to dramatically help their profit and loss, and this most likely makes their balance sheet far stronger than it was prior to the last crisis. But the main takeaway from this step and the main argument that I would give you as to why I don't think the collapse in the car industry will lead to a crisis is because the mortgage-backed securities back then and the mortgages themselves were much, much bigger in nominal terms. So back then in 2007, there was about $15 trillion worth of home loans. Today, with the auto industry, about 1.5 trillion. So even if they have a higher percentage of subprime auto loans, in nominal terms, comparing apples to apples, that's a much lower number than the amount of subprime mortgages we had prior or leading up to the GFC. Let me be very, very clear. The auto industry right now is in a massive, massive bubble. And this will definitely impact the US economy negatively throughout 2023. But I don't think it's going to be the catalyst to GFC 2.0. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.